Hey guys, bond yields are going up, and you're worrying about like the Fed, rate hike and how the cycles work, and what's the climb going to be like? What are market returns going to be like? Well, let's talk about that, right? Because bond yields are rising, right? And they might be rising quicker than we thought they were, right? Now, the U.S. stock market seems vulnerable to, a correction, right? Like it's we're either on the verge or in the middle of one, right? But what can you really tell from, a couple weeks into, a new year? Not much and quite a lot. Um, one thing that we can kind of feel assured about is the days of making easy money, right, are over in the pandemic era, right? Now, benchmark interest rates are headed higher and bond yields, right? Now, which these have been anchored at historically low levels, but they're destined to rise in tandem. Now, it seemed as if, Federal Reserve members couldn't make that point any clearer, right? Especially ahead of, the traditional media blackout that precedes the central bank's first policy meeting that we just had, January 25th, January 26th, right? We just had that. Now, the US consumer price and producer price index, they got released and only cemented the market's expectations of a more aggressive or hawkish monetary policy, right? Now, one of the only questions that we kind of need to be asking is how many interest rate increases will the, Federal Open Market Committee put out in 2022? JP Morgan Chase and Co., right? CEO Jamie Dimon or Demon, I'm not sure how you pronounce it. He, said that seven might be the number to beat, right? With market-based projections pointing to the potential for three increases to the federal funds rate in the coming month, right? Now, while yields for the 10-year Treasury note yielded about 1.77%, you know, here not too long ago, you know, it was pretty nice, right? But they might be getting higher. But with it hitting that, that's going to mean that yields have climbed about 26 basis points in the first like 2 weeks trading days of the starting of the calendar year, which would be probably one of the fastest, right? Such, of a rise like that since 1992, right? And we can confirm this by looking at Dow Jones market data, right? Now, back 30 years ago, the 10-year rose 32 basis points to around 7% to start that year. The 2-year note, right, 0.96, right, which tends to be more sensitive to the Fed's interest rate, moves, it's knocking on the door of 1%, right, up 24 basis points so far, right? Now, do interest rate increases translate into a weaker stock market? Well, as it turns out, during these so called rate hike cycles, right, which we seem to enter into as early as March, the market tends to perform strongly, not poorly. In fact, during a Fed rate hike period, the average return for the Dow Jones Industrial Average, right, is nearly 55%, right? Now, that of the S&P 500 is a gain of 62.9%, and the NASDAQ has averaged a positive return of 102.7%, according to Dow Jones, using data going back all the way to 1989, right? Now, Fed interest rate cuts, perhaps unsurprisingly, also yield strong gains, right? With the Dow up, 20 or so percent, S&P also gaining 20 or so percent, and the Nasdaq rising about 30 or so percent on average during a period of Fed rate cuts. Interest rate cuts tend to occur during periods when the economy is weak, and rate hikes when the economy is viewed as too hot by some measure. Now, this may account for the disparity in stock market performance during periods when interest rate reductions occur. For sure, though, it is harder to see the market producing outperformance during a period in which the economy experiences a kind of 1970s style inflation, right? Right now, it feels unlikely that bullish investors will get a whiff of double digit returns based on the way stocks are shaping up so far in 2022. The Dow's down a little bit, S&P, you know, down a little bit, and then the Nasdaq Composite is down more than both of them combined, right? So, what's going on? Well, let's talk about that. What's working, what's not working, and all that, right? So far this year, winning stock market trades have been they started off in energy, right? With the S&P 500's energy sector, right? Plus 2.35%, right? Looking at a 16.4% advance so far in 2022, while financials are running at a distant second of 4.4%. The other 9 sectors are either flat or lower. Meanwhile, value themes are making a more pronounced comeback and eking out about a 0.1, 0.2% weekly gain, right? But month to date, the return's about 1.2, 1.3%. Okay, well, what's not working? Well, growth factors are getting hammered so far as bond yields, they're rising because a rapid rise in yields make their future cash flow less valuable. Now, higher interest rates also hinder technology companies' ability to fund stock buybacks. The popular, iShares S&P 500 growth ETF is down 0.6%, right, for the week and down a little over 5%, so far in January. Okay, well, that's what's working, that's what's not working. But what's really not working? Well, biotech stocks, they're getting hammered, right? There's a iShares Biotech ETF, right? It's down 1.1% for the week and 9% on the month so far. A popular retail oriented ETF, right? SPDR, right? ETF. It tumbled a little over 4% last week, contributing to like a 7.5% decline, in the month to date, right? Kathy Wood's flagship ARK Innovation ETF finished the week down nearly 5% for a 15.2% decline in the first like 2 to 3 weeks of January. Now, other funds in the complex, including ARK, Genomic Revolution ETF and ARK FinTech Innovation ETF, I mean, they're kind of similar, right? Not doing too hot. There's other popular meme names that are also getting hammered with GameStop, being down, right? AMC being down, and they're just getting ran over, right? So I mean, when all this is said and done, it's just good to have information and make sure you're not scared about the market that is now, right? There's ups, there's downs, right? And we kind of felt like there was going to be a correction coming. So hopefully the market corrects itself. Don't panic sell, don't panic buy, right? You can buy the dip as it's going down, dollar cost average in. Be smart about what you're doing, right? That's what we're here to do. We're here to educate, get some information, make informed decisions, and come out better on the other side, right? Hope you guys enjoyed this video. If you did like it, hit that thumbs up button. If you're not subscribed to the channel, I'd really appreciate it if you did. Until I see you guys in the next video, y'all be safe.